What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
So happy to be here with you today. It felt like this was a big week for markets. We got a lot of earnings data, we got PMI data, we got employment data. It feels like there's a lot to talk about today. So why don't we kick it off and talk about maybe trying to frame this session on the three biggest topics of the week that we should be covering. First, I think we could talk about PMIs and the data that came out this week. Second, we can cover earnings and what's been going on through earnings season, which is now just about finished. And third, let's talk about the leadership rotation that we've been seeing.
Those are the three big themes that are driving markets and definitely have the attention of our team right now. The PMI data, which is something we focus a lot on, that is leading economic data, gives us a really good signal of the shifts in economic activity, and they've been unbelievably strong after a couple years of stagnation in the aggregate.
Yes, they have been absolutely strong. And this month, the July reading, we saw another uptick and a big surprise for the ISM manufacturing index, which is, as you said, it's one of our favorite leading indicators that we follow because it does correlate so well with markets. And just to kind of give a sense of how good the data was, we saw the ISM print, which came in at 55.6, and anything above 50 indicates expansion. So we are now well above an expansion. We are well into expansion territory. And we saw that the data beat, there were about 48 economists that submitted estimates, and this data beat 47 of those estimates. So definitely stronger than expected. And it was really a good print all around. So that was something that was really encouraging for our overall reacceleration of leading indicator story. And now at this point, after last month and continuing this month, we now have 100% of the US PMIs that we track that are in expansion territory, which is a big deal. We also have now on a global basis, 85% of global PMIs are in expansion territory. So it's not just a US story. This is a story that's been broadening and it's been gaining momentum. And it's something that has significant implications for markets more broadly.
Yeah, that's pretty crazy that the actual PMI number came in above so many individual estimates because we've had strong PMIs for a couple of months now. So the bar has definitely been set high and continues to deliver. And then on a global basis too, to see that many, so 85%, so only 15% of global PMIs are in contraction. That's a pretty bullish number for the overall economic breadth.
Absolutely. And I would say, to tie this into the second point I want to cover today, earnings, we're seeing a similar story on the earnings front. After the first quarter of earnings season this year, people were worried after the very strong first quarter that the second quarter wouldn't be able to keep up with the positive momentum we had in the first quarter, and that absolutely did not happen. The second quarter, which we're now 90% through for the S&P 500, so almost everybody's reported, and we have a beat rate of about 87%, which is just incredible. It's well above the long-term average of 72% of stocks beating, and even stronger than the first quarter. So certainly earnings did not disappoint this quarter. With about 87% of stocks beating, you saw positive surprises across the spectrum. The top sector in terms of percentage of stocks beating would be healthcare with 98% of stocks beating, tech had 92% of stocks beating, and even within utilities, which had the most misses in that sector, more than 75% of stocks have beaten estimates, which is still very strong. And again, above that long-term average for the S&P 500 of 72%. So earnings are strong. They continue to beat, and consensus estimates for this year, for 2026, continue to move higher throughout 2Q earnings season. We like to look at not just beats and misses as a way to gauge earnings, but also what analysts do with their estimates after hearing the earnings reports and after hearing from company management. So when we look at consensus earnings estimates for the S&P 500, we are now at $357, where we started the year at $311. So it's a huge move, and it's been continuing. So certainly earnings have been very strong, and that goes in line with that rise in PMIs. One of the reasons that we, as a strategy team, like to pay so much attention to PMIs is because they correlate so well with earnings, and we are seeing broadening out across both PMIs in the US and globally, and also earnings strength. So all good as far as continuation of this acceleration story.
Yeah, it's pretty incredible when you distill that down. It's earnings expectations and earnings, the growth numbers people are expecting are going up, and then companies are beating those expectations. And those are two things you don't necessarily always see. Typically, calendar year earnings drift down as we get longer in the year, the expectations of what things are going to be, and then we drift lower. You still have a positive growth rate, but you start, and that number in reality, as we get closer, converge, and it's usually to the downside. In the last couple of years, it's been to the upside, which is a sharp departure of 40 years of data that we have on how these estimates evolve. And then to your point, of companies are beating on top of that. And that really goes to that broadening story, which has been a big theme of ours on the back of this idea that you are going to see PMIs and these leading economic data continue to accelerate and the breadth behind that. It's been a pretty incredible story, which goes into the leadership you're seeing overall in terms of size and style, with smaller cap stocks doing better after their stagnation over the last couple of years of not really having earnings growth. I think year to date, it's what? Small cap growth, small cap core, small cap value, then mid cap and all their classes, and then large cap at the bottom of the year to date size and style performance table.
Yep. And large value, which has become the most defensive of the size and style boxes, is the worst performing of all of them this year, but it's still up 10%. And then you've got small growth, the best performing out of all of them this year, up about 25%. So a big range, but everything is up, and everything is up double digits, which is quite impressive. But to your point, we are starting to see a bit of a rotation as this cycle matures and broadens out. We started off, as cycles do. When you see PMIs that are low and start rising, you tend to see beta and risk do really well out of the gate early in a PMI recovery. And we did see that very strongly. The last few months, we've seen quite a change in that. Beta has rolled over, momentum has rolled over. But what we are seeing, that does not mean that we're seeing defense lead by any stretch. We've seen some significant outperformance of value factors, which is something that you tend to see as the cycle matures. You tend to switch from beta leadership to value leadership, which is happening now. And so that's something that we are now looking for, more cyclical value, quality cyclicals, as opposed to beta, which is what tends to rip right off the bottom. And we are starting to see that very much in the market. And that is, to us, a bit of a signal that this cycle is maturing. And we are seeing that also more as the PMIs continue to rise and the earnings broaden out beyond just a couple of years ago. We saw just the Mag 7 and names, mega cap growth names that were seeing strong earnings growth. Now it's very significant across the board. And so we are seeing a shift in that leadership.
And that's not a negative. That is just the maturing of a cycle. And it's still a bullish signal. We're just moving past that initial kind of euphoria risk phase and moving into a broader participation rate, which is a good, healthy sign for equities.
Absolutely. And I would say this week has been really strong all around for equities, because we had that strong PMI, which indicates, again, the improving cycle. Earnings continue to come in very strong. And then on Friday, we got the relatively weaker than expected jobs report, which puts a limit to how much the Fed can do in terms of raising rates. And so that also is a positive, because if the Fed can hold off on raising, that just elongates how long this can go, this positive story can go. So all around, this has been a very encouraging week for the equity market all around.
Great. So those three topics definitely are big themes in the market and are really driving investors and really driving investor positioning and the overall equity sphere. The obvious question, you gave it for point number 3 about leadership. What's next? Where do you see, one, PMIs going from here and the kind of outlook for that, earnings, and what is the positioning picture for the next few months into 2027?
Yeah, that is the big question. We like to do, on the strategy team, we like to use different series to forecast PMIs, proxies of inflation and proxies of rates, to forecast where the PMI is heading. And we have a whole assortment of charts that we look at, and they are broadly suggesting that PMIs can continue to rise and continue to be strong well into 2027. So we don't think that this PMI story is over by any stretch yet. We still think that there is a runway of 6 to 9 months where this can continue. So in that case, we still think that we're still constructive on markets. We're still constructive on having more of a cyclical tilt in your portfolio. But again, we do think that probably the best days for beta and lower quality stocks are behind us, but that doesn't mean you want to get defensive yet. We are looking for value. We're looking for cyclicals, but not quite as high beta as we were previously in terms of what was leading. So I would say factors like earnings yield and earnings momentum, earnings surprise. These are some of our favorite factors here because we are in this very much earnings driven backdrop. That's what's driving markets. That's what's driving the continued rally in equities. And so that's an area that we're targeting. And we also like to look at one of the favorite tools that we have that we've built out is we look at how correlated stocks are to the PMI. How correlated is price performance of each stock to the ISM index? And so we are looking for stocks that are positively correlated to the ISM because we do think that there's continued upside there. That's a factor that has done well as we've gone on this journey from PMIs being stagnant to now rising pretty sharply over the last couple of quarters. And that's something that we expect to continue. So we continue to be constructive. We think there's still a long roadway ahead of constructive equities and cyclical leadership. And the longer that we can go with the Fed not hiking, the longer this can go on.
So keep an eye on fundamentals. The fundamental economic data, PMIs are, in essence, the fundamentals of the economy, continue to be strong, earnings continue to grow, and focus on investment themes where it's about fundamentals. And it's not necessarily about expectations in the future. It's about companies producing and delivering today.
Yes, absolutely. And one more thing before we end, I just want to say, because I thought this was interesting, given all these positives that were coming out this week, we did get a number of new all-time highs this week in the market. S&P 500, the Dow both made new all-time highs. And at the sector level, industrials and financials both made new all-time highs this week, which I think just speaks to the broadening out of this story. It's not, tech obviously has been doing very well and had a strong week as well, but didn't make new all-time highs this week. It was financials and industrials. So the broadening out story continues, and we are excited about looking ahead. We'll be monitoring the data closely.
Thank you so much, and I look forward to having you on again soon.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.